After 7 months learning this trading strategy, the student made $1,190 within a week, and the next week $910. And you can see also that even though the strike rate is not that high, that means winning trades are only by 3 winning trades and 4 losing trades. Or here, 4 winning trades and 2 losing trades, and the trader still makes a huge amount of money in reference, because the advantage of this trading strategy is money management. There was a month where the trader had 13 losing trades and 2 winning trades. And we're going through all these things inside using this trading strategy, and I hope this can make you a better trader, because you can see here obviously how the trader has 13 losing trades and only 2 winning trades, lost $660 within a month, very important. But within a week, the trader just had made $1,190 and another week $910. So you see within just 2 or 3 trading days, the trader does everything back using a good money management, using this trading strategy. So this is a 1-minute trading strategy. We have always 3 steps. That means first of all, it is to understand that the market will always aim in the US session for the biggest structure high and the biggest structure low. The question may be like, can I also trade gold or euro, US dollar or other things? And I think the best thing is to double down just with one single market. This would be the S&P 500 future between 9 a.m. and 4 p.m., just selecting anywhere 1 or 2 hours. You will have very obviously enough trading opportunities using this trading strategy and market. Especially because it's a 1-minute chart, we have 60 candles within 1 hour, and there are clear trading criteria. First of all, understanding that the market is aiming for bigger structure highs and bigger structure lows. Sometimes you even have smaller structure highs and lows. That means such as here, what I'm drawing in here, here. That means you just need to look at the structure to the left. And very important is that the market didn't touch the structure yet. It means in this key reference, it's red and green. So everywhere where you see red and green, I'm going to zoom here inside because of my screen here. And I'm going to show you this one here. See red and green, red and green, red and green, right? And the next red and green is here. But the thing is now from the structure perspective, the market was touching this one already. That means when trading here where our number 1 is, the most important thing is just like, check this out. Here, this one was also being touched already by the market. So that would be this low here and this low here and this low here, where you can see here the blue lines, what the trader was drawing in. Step number 2, can we see right now that the market is going to one of these bigger or smaller structure highs or lows to identify that the market is in an imbalance? That means like balance is just like the market is not going in one direction, but imbalance, it means like the market is clearly going in one direction to us. And with that, we can use actually 4 things, but I would like to list 3 things what are more easier. And it is a lot of red, more red than green candles. So here we can see more red and green candles, for example. Then you can see that the market is clearly going also lower, because sometimes you have a lot of red candles, but the market is not clearly going lower that much as you see on the left side. But here the market has a couple of red candles and it has a push. So more red and green candles, more push in move, and then also more length down and length up in reference. So here you see the length down just within like one push, those red candles, for example. And then all the green candles in a row you see here is just around 50% or something, especially here, this full push here in reference to here, in reference to this move up, in reference to this move up. The moves down are way more longer, as you see here and there, right? The third key component is literally to see that the market has more candles in time down here than up here, because it just means to us that people want to trade lower by seeing just that there are more candles, what is absolutely nice. So when having that identified, these 3 things, we can say for each trade, by the way, what is really awesome. That means we don't need to trade up here and just guess. We can start reading. We can wait until the market is really making a lot of candles more lower, making more red and green candles, and we have still a lot of trading opportunities. We will go to step number 3, and it means we aim for our target. This is our next reference here. Next reference is there. And then we take a green and a red candle for trading down, or a red and a green candle for trading up. It is about to have so many as trading opportunities as possible. Here you see green, red, 1, 2, 3, 4, 5, 6, 7. So all these trading opportunities you see here of green, red are good trading opportunities to And this is where the money management comes in, to adjust $100 to make $500. So here you can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. And each color switch we are allowed to trade using this trading strategy. The thing is, once we can see quantity, we can now crank up with quality. And quality means which of these color switches makes more sense. That means if you see that the market is retracing back, that means it's bouncing back. You see here how the market is bouncing more back in length. What makes these color switches up here more interesting than just a color switch, for example, than down here in this area here. When you see that the market has more red candles, as you see here, this makes this trade here so interesting here. Then where the market is here a bit structuring higher, like this is how you go a bit with quality. That means like either having at the highest point to trade, that means here or there on those highest points, or the other one is on the lowest points where the market is literally structuring lower with power. This always depends. Keep in mind that it is absolutely normal to be stopped out for once or even twice. Sometimes we need a second or third trade. This is where money management goes in. When having enough leverage, please use a demo account always, especially trading the S&P 500 future, or we trade micros. The thing is that micro is just a smaller market that you can adjust $5, $10, $20 or $30 on average, or even 50 or 70, however you like. But when you trade the S&P 500, it will be $100 on average. Sometimes it's 70, sometimes it's 120, depends on how the market runs, because sometimes we have taller candles, sometimes we have smaller candles. So what you can see here is that we have here a very small, tiny red candle here. And when adjusting here the $100 after the red candle closes and it's a color switch, and we have our criteria met. We have more red than green candles. We have more candles down here. We have lots of color switches, and we decided what color switch we like to trade. Here you can see, for example, T1. This was an actual trade the trader took. We adjust $100 here. Stop placement is on the same candle. That means if the market goes against us within 5 seconds, 20 seconds, or 1 minute or 2 minutes sometimes, or 3 minutes, then we lose $100. But if the market goes in our direction, then we make $200, $300, $500, $800, or even up to $1,500 for some trades, what is absolutely awesome. There are days where it's more obvious, and there are days where it's less obvious. And we're going to look at 2 days here. So you can see 3 days here. So you can see here how the market is trending down, and we have here a lot of trading opportunities. And the next one is here. You see here how the market is structuring up. This is where the trader started. You find here a lot of more green and red candles. You find here higher, the market does more candles than here or there here, for example, which shows us acceptance. And then first starting here, the trader starts to trade. It means here we have the time to read what the market is doing. And then you find here the first color switch, red and green, adjusting $100, losing 100. And then you see here the second trade, adjusting $100, making 600 or 500, as you see here. It says here T3 had a risk reward of T2. The second trade had a risk reward ratio of 1:7. That means the trader here made $700. So losing $100, making $700, having $600 left. Then you see in the third trade, losing $100. And then you see on the fourth trade, the trader did $400. That means the trader made minus $100 here, and then plus $400. That means plus this is 300 here, so you have $900 what the trader did for the day. And this all only by using $200 in money management a day in average. Very important. And also to say, we also say that if 2 trades are not working, or 3 trades maximum a day, we stop trading, and mostly at 2 trades a day. So we can either say at 2 trades a day we stop, or also in combination that at $200 a day we stop. Sometimes it's going to be 250, 260, depends on how the market is running, because if the market looks like this, I'd rather have 3 losing trades than if the market looks like this here, for example, because this is here in comparison how the market looks less nicer. I'm going to show you an example. Here you see how the market is running nicely in a direction. Here also very nice structured, how it structures in a direction. We have a clear target here on the left side, a bigger structure high. We have these medium structure highs here. Those are the blue lines here that you see here. Those are very nice to use. So each time from a green and red, the highest wick here, green and red, the highest wick here, green and red, the highest wick here. And then the next step here is this one and this one. So actually aiming for one of these highs is very important, because what happened to this trader for 1 month was, this trader is learning now since 7 months. And what happened to the trader was that the trader had 13 losing trades and only 2 winning trades and lost $660. But keep in mind, within a week, she's making around $900 to $1,200 on average now by changing this thing with money management. And the other thing was also that aiming better at the take profit targets. That means if you see that the market is going up here, I'm just going to show you this one here. This was a huge difference, because the thing is, she analyzed very well. But the thing is, just look at this. This is our high here, and here you have also color switch our high, or we use this one from the 1-day VWAP, just an old value here. That just shows us that when trading in this direction until this line here, we want to trade in this direction before the market touches this line. This is our target. If the market starts touching these targets, what I was just drawing in, these horizontal black lines, then what happens is that our trade quality is being extremely decreased. It means when seeing that the market does a lot of green candle wiggles up and we have our target, it is to squeeze in the trade, what is very important. That means here the trader is squeezing in before the target is met. On the right side, you can see how the target is met now. Here, it touches now our target, this smaller structure high here. And what happens then is what the trader did previous month is the trader started trading here 2 or 3 times sometimes. And this is where the trader lost a lot of money that was not real, a demo account. Very glad. This is the reason why a demo account is so important to understand. And this is the difference by if you have a trading strategy that works, if you have experience from someone else who is doing this already over 5 years using the same trading strategy, is that literally, in this case, it's 2018, but using this within 5 years I'm teaching now. And the thing is, it is very often the same, that it is about to understand when do we need to squeeze in 2 or 3 trades and when not. Because the thing is that when trading to our reference, this has the highest quality. But once the market reached this reference already, our quality is being decreased by 5 times. It's insane. You could take 5 trades up here and it could all not work. But if you take here 2 trades, very often the second trade or the first trade works. What is also very interesting is that even though the market reaches the target here, what the trader did here is that the trader used here the anchored VWAP. This is a volume weighted average price. What is very awesome. It just helps the beginner with retracement. You can see here how the trader took then the first green candle. It just helps to identify, instead of trading up here, to trade down here where the circle is. And the trade literally worked also, what was very nice. That people take trades such as T3, what is too high because the market reached already the target, is totally okay. Because in trading, when having good money management, you can see here within 3 trades, the trader did $1,310. And each trade, the trader is losing an average $100. That means the trader can afford now, because the trader made this week $900, could even afford 5 more losing trades and still make money. That means even though with the low strike rate of 15 or 20%, the trader could still make $1,000 or $2,000 within a month, of course, when having also enough trades. It's more about and this is something what is very important. When it comes to real money trading, when we have only one trading signal, the one perfect trade, like this one perfect signal here somehow, then the problem is we may get just stopped out or we may just hesitate. But if we have multiple opportunities, that means seeing here 1, seeing here 2 color switches, 2 trading opportunities, then here the 3rd one, or here 4th one, and a 5th one here, as you can see here. Then out of 5 trading opportunities, it's just about to take any of these and having the courage to take actually the trade where the criteria is met, where we have lots of green candles, the market is going clearly on a going higher or lower. We have more length that the market does up than down. And also we have more candles on the upper side, for example, than on the lower side, which shows us, of course, that the market allows to shift more in that direction. What is helping us to identify more high quality trades to actually take them with real money.